pension funds are actually a really important vehicle for addressing climate change. Roughly $13 trillion is held in the form of pension funds, and what's important to understand is the nature of the return that those pension funds are looking for, and also the duration of the period over which the pension funds are hoping to achieve that return. So they're a unique type of asset class in a sense, or investor class I should say, in the sense that they're looking for long duration investments, and the rate of return would be something which is inflation hedged plus an additional return. So something on the order of, let's say, 8 to 10% given current inflation rates. And the reason that's important is that it allows you to do innovative types of projects in the carbon sphere over a longer period. So let me give you a concrete example to illustrate that point. Essentially, you could take a long duration type of investment, such as an investment in an area of forestry, and you could have those pension funds be committed to those forestry assets for a period of, let's say, 25 to 30 years. Now, as long as those forestry assets were generating returns on the order of 8 to 10%, that should be a reasonable rate of return. Now, what's interesting about linking this to climate change is that we're in a situation over the next couple of years when climate change policy on forestry carbon is about to be decided. So one of the initiatives that Merrill Lynch is looking at is, can we somehow pull together investments in forestry with the returns that could be realized from the value of the carbon sequestered in the forests? And we think that would be a very innovative way to help those pension funds realize additional returns. I think there's a couple of important things to keep in mind. First of all, the integration of carbon considerations into a bank like Merrill Lynch needs to be done in a way which aligns the vision of where we think the bank is going with our own environmental stewardship, because it's not enough to focus just on the business opportunities. We have to have our own house in order, so we have to reduce our own carbon footprint. We have to introduce procurement of green energy, for example, and look for those continuous improvements over time. The third point is to have governance. You have to have a clear framework through which you manage climate change. And that's something we've introduced in September with the launch of an environmental sustainability set of principles. And the fourth dimension is that business opportunity as well as the business risks that carbon presents. And so how we're doing that is we're thinking about carbon as it affects each and every part of our business, which for us means fixed income, currency and commodities. The second piece would be investment banking, and then the third piece is wealth management. And so what we're doing is we're looking at where is carbon posing a risk or an opportunity in each of those different areas. As a good example, we have a carbon market, so that's a very clear opportunity for the commodities area. In the area of investment banking, you have opportunities to help raise capital for companies that have a very strong low carbon technology opportunity. Then you have opportunities in principal investment and private equity. So we're putting Merrill Lynch's own money at stake, using our own balance sheet to make investments in companies that we think will benefit from a shift to a low carbon economy. And for wealth management clients, there's a huge scope for innovation, because you have different types of individual clients that come into that category. Some who are looking for climate proofing their investment portfolio, others who are looking at taking a patient capital approach. So they're willing to forego some immediate returns, but they would like to get some upside at the end of their investment. And that's another way that you can introduce climate-related themes. And then the final category would be those who are looking for climate change-related investments to outperform mainstream investing. And quite frankly, the way we're looking at the evolution of climate change policy, we think there's a lot of companies who stand to benefit significantly from the increase in interest on climate change, both from a policy perspective as well as through the creation of the carbon markets. The final important way that a company like Merrill Lynch engages on this topic is not on the business side alone. It's really about policy engagement. We think we have an important voice. We need to be engaged with policymakers, so that's something we're doing in places like Washington and Brussels, so that we can try to ensure that the policies which are introduced are as market-friendly as possible, because we think that's the best way to deploy capital towards low-carbon solutions. Merrill Lynch is heavily involved on policy engagement. We think it's important in this period where the carbon market is reaching an adolescent stage and needs to go to full adulthood, which will come when we see more regions coming under carbon constraints. So we're very optimistic about the way the US is evolving. We think that there will be a national cap and trade scheme in the US, but it's very important that the design of that scheme be as market friendly as possible. And so that's really where we're adding our value. We've been trading emissions in the European Emission Trading Scheme since 2005. We think there's lots of lessons that can be learned, both from the successes and from the failures, of how to ensure that the US system is a success as well, and that will link into the broader Kyoto market. The same thing is true in Australia. Australia, we think, will have a cap and trade scheme by about 2010, 2011. So again, it's very important to make sure that that scheme is as market friendly as possible. In terms of post-2012, the way that we're engaging is to try to make sure that there is agreement reached in Copenhagen in 2009. That is absolutely critical to ensure that there's no, if you like, a hiatus in the carbon market where carbon finance has to pause to wait to see what happens in the next evolution of the climate change treaty. That, I think, would be a disaster. In other words, if there's no agreement in Copenhagen 2009, that would be a disaster. The adaptation challenge is the most difficult one facing the financial sector. How does one begin to project the physical impacts of climate change, whether it be precipitation changes or temperature changes, or even real disasters such as extreme weather events and sea level rise? What we're trying to do is understand the time frame and the magnitude of those potential impacts. And so we do that in the short term through our weather derivatives desk. We actually have 4 full-time PhD meteorologists working in our commodities team to give us a view on how those kinds of changes will impact all of the different commodity markets that we work in. So whether it's agricultural softs, or the fuel markets, or obviously the carbon markets. And that's one way that we can introduce those kinds of considerations into the decisions that we're making for ourselves as well as for our clients in the commodity markets. But beyond that dimension, there's an issue about how the physical impacts of climate change may affect the fundamental valuations of companies in terms of the impacts on their assets. And that, I think, is a much thornier one, and one that we're addressing through our involvement as the global lead sponsor for the Carbon Disclosure Project. This is, we think, one of the most important forums for dialogue between the financial markets and and companies. The Carbon Disclosure Project currently represents something like $57 trillion of assets under management. And so we think that by companies understanding that the financial markets want to know what are the emissions, what are the risks, what are the opportunities, and what are your strategies for managing climate change, part of that is going to focus on the physical impacts. And increasingly companies will have to provide more granularity as to the specific risks, the timeframes, and the magnitude of those risks.